Hey, this is Matt and welcome to my channel, Let's Not Be Fools. Today we're going to talk about 401k plans. You may be wondering what a 401k plan is or how it works. Well, let's get into it. So by definition, a 401k plan is a defined contribution plan where an employee can make contributions from his or her paycheck either before or after tax, depending on the options offered in the plan. The contributions go into a 401k account, with the employee often choosing the investments based on options provided under the plan. So if your employer offers a 401k plan, they will likely give you a selection of mutual funds in which you can choose to invest in. They could be bond funds or stock funds or mixed funds, balanced funds, or even target retirement funds. So you'll have several funds probably to choose from in your 401k offering. In the year 2019, the maximum contribution is $19,000 if you are under age 50. If you're over age 50, you can contribute up to $25,000 due to a catch-up allowance of an additional $6,000 because you are rapidly approaching your retirement age. Typically, employers will match your contribution up to a limit. Some employers will match dollar for dollar up to about a 5% withholding. So if you withhold 5% of your paycheck, they may be willing to match up to your 5% withholding dollar for dollar. So if your 5%, let's say, is $100 that pay period, your employer may match up to that $100. So you're contributing $100 and your employer is contributing $100. So netting out, you're making a $200 contribution to your 401k plan when you combine the two contributions. So let's assume your company is willing to match your contributions up to a 5% limit. So your withholding would be 5% and your company match would be that same 5%. So if your earnings that period was $1,000, your contribution would be $50 and your employer's contribution would be $50. That $50 is free money they're giving to you. Always consider it that and always get that match. So the total contribution would be $100 for that pay period. Let's assume your company only matched up to 3% and you still went up to 5%. So your 5% contribution, they match it up to 3%. The same earnings that period, $1,000. Your contribution is $50. Your company's contribution is $30 for a total of $80 going into your 401k account. Let's say you contribute 10%, but again, your company is limited to the amount that they'll match. Let's say it's 5%. Your earnings are $1,000. You can contribute $100. Your company will still chip in $50, and your contribution is $150 for that pay period. I always encourage you to withhold at least 10% of your paycheck, if not more. 15% would be even better. 20% would be ideal if you can even swing that. Keep in mind that your contribution can be made on a pre-tax or after-tax basis. If you make it on a pre-tax basis, then you're actually tax deferring that amount. So they will take that amount out of your income before they figure in income taxes, and you'll be taxed on the amount that you make after that contribution is taken out. But again, that's only tax deferred. You will be taxed on it later on in life when you actually make a withdrawal from your 401k account if you make it on a pre-tax basis. If you make it on an after-tax basis, then those are after-tax dollars and you will not be taxed on the dollars you contribute, although you will be taxed on the dollars that you make or accumulate as a result of your investments. Your employer's contribution is always considered pre-tax. So when you take your money out later in life, the full amount, both the contribution of the employer as well as any capital gains it's made, it'll all be taxed later on.
This content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice.
So let's take a look at your after-tax versus pre-tax options when it comes to your income. We'll assume your modified adjusted gross income for this year is $64,000. If you make an after-tax contribution to your 401k plan, you're not going to get the immediate benefit of the tax deferral and a tax adjustment in terms of your income. You're not going to get that tax deduction. So your adjusted gross income will remain at $64,000 and your federal taxes due will be $9,939. Whereas if you contribute to your 401k on a pre-tax basis, and let's assume you were able to contribute $6,000, your adjusted gross income will then equal $58,000. Taxes due on a federal level would be $86.19, which means your taxes were lowered by $1,320 as a result of contributing that $6,000 to your 401k plan. Now remember, contributing on a pre-tax basis just means that you're contributing on a tax deferral basis, and the money, that $6,000, and any money that accrues on top of that due to your investments will be taxed later on in your life when you make a withdrawal, and it'll be taxed at your income tax rate, not at a capital gains tax rate. Keep that in mind. So remember, your company's match is free money. Absolutely take it. And whether you contribute on a pre-tax basis or an after-tax basis, always contribute at least up to the matching amount that your company is willing to give you. It's free money. If they match 3%, withhold 3%. If they match up to 5%, withhold 5% of your paycheck. But do it. Do it now. Do it today. Do it tomorrow. Don't wait. I hope you enjoyed that presentation. I absolutely encourage you to join your employer's 401k plan if they have one, and absolutely contribute up to the point where they match. It's free money. Don't let it go. And if you have any questions, go ahead and leave them down below, and I will answer them if I can. Have a great day.